If you own gold right now, or you've been thinking about buying some, I want you to hear this one sentence before anything else. The biggest banks on earth just quietly agreed on something they almost never agree on, and it's about gold. And most regular people have no idea it happened. I've been around markets for over 30 years now. I've built companies, I've lost money on trades I was completely convinced about. I've made money on trades I almost talked myself out of. And somewhere in there, you develop a sense for when something in the room is actually changed versus when it's just noise dressed up as urgency to get clicks. What's happening with gold right now is not noise. I'm not going to sit here and promise you it will double by next spring, because anybody who tells you that with a straight face is either lying to you or lying to themselves. What I'm going to do over the next half hour or so is walk you through exactly what changed, why it changed, why the pros are quietly repositioning around it while most people are still arguing about it in comment sections. And one specific thing the professionals watch for that almost nobody outside a trading desk has ever been taught to see. Stick with me. This takes some time to unpack the right way, and I'm not going to insult you by turning it into a 15-second soundbite that leaves out everything that actually matters. Before I get into the substance, I need to ask you for something, and I'll just say it straight instead of dancing around it. If what I'm about to walk you through is even half as useful as I genuinely believe it is, it's worth more than a lot of the paid research I used to have to pay real money for back when I was sitting on a trading desk every morning. I'm giving all of it to you here for free. All I'm asking in return is 30 seconds right now. Before you get distracted by a notification and forget entirely, hit subscribe. Not because my ego needs the number to climb, because I put out videos like this every single week, walking through exactly what I'm watching in real time. And if you're not subscribed, the algorithm quietly stops showing you the follow-ups, and you'll miss the part that ends up mattering more than this one. Go do it now. I'll wait right here. All right. Let's actually talk about why gold did something recently that made a lot of very confident people very uncomfortable. For most of this year, gold ripped higher. The kind of move that gets written up in every financial headline you can find, and then it stalled, then it gave some of that back, and if you were holding it through that stretch, you probably felt that little pit in your stomach. The one that quietly whispers, "Did I get this wrong? You did the responsible thing. You bought protection while the world felt like it was catching fire, debt piling up everywhere you looked, wars dragging on with no resolution in sight, money getting printed like it's free, an AI boom that looks a little more unhinged by the week, and then you watch your gold just sit there, maybe even slide a little. That's not bad luck, and it's not because you got the trade wrong. In markets, that's called digestion. And I've watched this exact movie play out in real estate, in tech stocks, in my own companies, more times than I can honestly count. The fast money that jumps in early gets shaken out first. The headlines turn negative right on cue, almost like clockwork. The people without real conviction sell right back to the people who actually understand what's happening underneath the surface. And 6 months later, everybody acts like they saw the whole thing coming from the start. Gold is doing that exact dance right now. And here's the part nobody on the evening news is telling you. This pause isn't the end of the story. In a lot of ways, it might be the single most important chapter of it. So here's what's actually happening underneath the price. And I want you to really sit with this one because it's not intuitive at all. For roughly 40 years, there was an almost sacred relationship in markets between gold and real interest. When rates went up, gold was supposed to go down because gold doesn't pay you a coupon. So why hold a shiny rock when a government bond is handing you a real return every single quarter? That relationship held reliably for 4 straight decades. It just broke. Rates have stayed elevated and gold kept climbing anyway, month after month, ignoring the old playbook completely like it never existed. When a rule that has been held for 40 straight years suddenly stops working, that's not noise you brush off on your way to the next headline. That's the market telling you loudly that something structural underneath has changed. And the textbook everybody grew up trading off of doesn't apply the same way anymore. What changed isn't trust in gold. It's trust in paper. Central banks all over the world, not just one or two of them, dozens, have been buying gold at a pace we genuinely have not seen since the early 70s. And they are not doing that because it looked like a fun trade in a Tuesday afternoon meeting. They're doing it because they're quietly hedging against a future where the dollar isn't the automatic, unquestioned center of the financial universe anymore, where sovereign debt keeps stacking with no real plan on the table to ever pay it down, and where the people who actually run monetary policy for entire nations are voting with their real balance sheets instead of their polished public statements. When a central bank buys gold, it isn't day trading. It's not selling 6 weeks later because a headline scared it. That kind of buying doesn't show up on a chart as a spike. It shows up as a floor quietly sitting underneath everything else. Now let's actually talk about the debt, because honestly, this is the part that keeps me up more than anything else in this whole story. And I say that as somebody who has never been a doom and gloom guy by nature. I like building things. I like betting on growth. I've spent most of my career betting on the future, getting bigger, not smaller. But I also believe in looking at a balance sheet honestly. Whether it belongs to a company I'm buying into or to a country I happen to live in and pay taxes to, government debt levels across the developed world right now are at a point where, historically, there are only really a handful of ways this ever gets resolved. And none of them are painless. Option 1, you grow your way out of it, which sounds great in a speech and almost never fully works once you're this deep in the hole. Option 2, you default outright, which no politician on earth wants to say out loud because it ends careers overnight. Option 3, you quietly inflate it away, letting the currency lose purchasing power year after year while technically never missing a single scheduled payment on the debt itself. Ask yourself honestly which option every government in recorded history facing this exact problem has eventually chosen when push came to shove. It's the third one, almost every single time, going back centuries. And gold has been the one asset that's so protected regular people through that exact playbook for roughly 5,000 years across basically every civilization that's ever tried this experiment on their own citizens. That's not a coincidence, and it's not a marketing line I'm using to sell you something today. It's simply what happens to a scarce physical asset that isn't anybody's liability when the people running the printing press start leaning on it harder than they ever have before in living memory. And then there's a piece almost nobody is connecting back to gold. And honestly, it should worry you a little because it worries me. Right now, there is an enormous build-out happening around artificial intelligence, data centers, chips, power infrastructure, the whole stack of it. And a huge chunk of that spending is not coming out of pocket from cash on hand. It's being funded with debt. And a lot of that leverage is sitting in places that don't get anywhere near the same scrutiny a public company's balance sheet gets from analysts and regulators every quarter. Some serious research desks have actually tried to seize the hidden leverage tied up in all of that infrastructure spend, and the number being thrown around is somewhere in the trillions. I want to be clear here. I'm not telling you AI isn't real or isn't going to change the world, because I genuinely believe it will. And I've put my own money behind that belief more than once already. And what I am telling you is that when you stack a debt-fueled boom in one corner of the market on top of already stretched government balance sheets everywhere else, you get exactly the kind of fragility that has historically been the trigger for a flight into hard, tangible assets. Credit markets have already started flashing some of the same early warning signals we saw right before the 2008 crash. Quietly, in the corners of the market, nobody's covering on the evening news because it doesn't make for exciting television. I'm not telling you we're repeating 2008 beat for beat. That would be irresponsible of me. I'm telling you smart money hedges before the headline breaks, never after. And gold has been the oldest hedge in the entire book for longer than any of us have been alive to remember. Here's where I want you to slow all the way down, because this next part is the actual skill. not just another scary story to keep you watching for another 5 minutes. There's a specific pattern that professional traders watch for constantly, and most everyday investors have genuinely never even heard of it, let alone learn to actually spot it themselves. It's not magic, and it's not some secret formula locked away behind a paywall on a trading desk. It's simply this. After a sharp move higher in any asset, price almost never just keeps sprinting in a straight line. Forever. No matter how strong the story behind it is, it pulls back, it goes quiet, it trades sideways in a tight, almost boring range for a while. And that quiet, boring range is very often the market building a base before the next real leg up even begins. The traders who've been doing this for 20 or 30 years aren't guessing when that phase is unfolding. Underneath their feet, they're watching volume dry up on the down days. They're watching each pullback get shallower than the one before it. They're watching the asset stubbornly refuse to give back the majority of its prior gains, even when that week's headlines turn genuinely negative and scary. That refusal to break down is the actual tell. It's the difference between a dead cat bounce about to roll over completely and a genuine reset happening right before a bigger structural move gets underway. I can't teach you every nuance of reading that pattern properly in a single video. Nobody honest could do that in 30 minutes. But I can tell you plainly that what I'm watching in gold right now has the fingerprints of that base building phase all over it, not the fingerprints of a top quietly rolling over. And I need to be very direct with you here, because I've watched too many people get hurt by skipping this exact part. Do not go out and buy anything just because I said a pattern looks constructive on a screen. Do your own homework first. Understand position sizing before you touch a single dollar of your own money. Understand that patterns fail sometimes, because absolutely nothing in markets is guaranteed, ever. And anybody promising you a sure thing is either lying to you or lying to themselves first. Let's zoom all the way out to the history here for a moment, because I think this is actually where it clicks for most people watching. Go back and look at every genuine structural gold bull market of the last 100 years. Not the little 6-month rallies that fizzle out, the real multi-year ones that reshape portfolios. There's the one after the world came off the gold standard in the early 70s. There's the one during the brutal stagflation grind of the late 70s into the early 80s when nobody trusted paper money for good reason. There's the one after the Soviet collapse and the currency chaos that followed across half the globe in the 90s. There's the early 2000s run after the dot-com bust and a couple of expensive wars nobody wanted to honestly pay for on the government's own books. And there's the one that kicked off around 2018 and accelerated hard once the pandemic response hit the printing press at full speed with no brakes. Different decade every single time, different headline crisis every single time. But the same underlying mechanism runs quietly underneath every one of them. A shock happens, trust in the existing financial system takes a real hit, and money slowly rotates into the one asset that has been trusted longer than any currency, any bank, and any government that has ever existed on this planet. I'd argue we're sitting in the early to middle innings of exactly one of those cycles right now. And if I'm right about that, the noisy, choppy, frustrating stretch you just lived through holding your gold position isn't the end of the story at all. Historically speaking, it's been the part that shows up right before the trade actually gets. Interesting for the people who stayed in it. There's one more piece of this puzzle I haven't touched yet, and it's the one that honestly convinced me. This isn't just a Western story playing out on trading floors in New York and London. Look at what's happening with gold demand coming out of Asia, particularly China. Import numbers there have been running well above normal for an extended stretch. Now, and that's not just retail jewelry buying driving those figures higher. Those are much bigger flows, the kind that typically involve institutions and quietly the state itself behind the scenes. Add that to what India has been doing on the demand side for generations culturally, where gold has never actually stopped being treated as real savings the way it briefly did in the West for a few decades of overconfidence. and then zoom out to the currency picture more broadly across the world, there's been a slow, steady conversation happening among a handful of major economies about reducing how dependent they are on the dollar for trade settlement, for reserves, for everything in between. I'm not telling you the dollar is about to collapse tomorrow morning. It isn't. And anybody selling you that particular story is being dramatic purely for clicks and views. What I am telling you is that when the world's largest economies are simultaneously buying more gold, importing more gold, and having quiet conversations about diversifying away from a single currency all at the same time, that is not four unrelated headlines you can just skim past. That's one story being told from four different directions at once, and every one of those directions points the exact same way. I've sat in enough rooms with people who genuinely move real money to tell you when multiple unrelated players start behaving the exact same way for different stated reasons, that is usually the moment worth paying real attention to, not months later after everyone's already talking about it on the nightly news. Now let me give you something practical here, not just theory, because theory alone doesn't pay anybody's bills at the end of the month. There are two types of people who end up living through a moment exactly like this one. The first type sees the pullback, feels that same pit in their stomach I mentioned earlier, and quietly sells somewhere near the bottom, telling themselves the trade is over and they should have taken profits at the D's top when they had the chance sitting right in front of them. They spend the next few months chasing whatever's hot that particular week instead, jumping from story to story, always a step behind the move. The second type sees that exact same pullback and reads it completely differently. They see a shakeout. They see a structural setup that, if anything, looks stronger now than it did before the pullback even happened in the first place. And they add calmly, roughly around the right time, not because they're trying to nail the exact bottom to the penny. Nobody alive can do that reliably, but because they've trained themselves not to be completely, obviously wrong the way most people end up being when emotion takes over. This was never about being the smartest person in the room, or the richest one, or the best connected. It's about actually understanding the rules of the game instead of reacting purely on emotion every single time the price moves against you for a week or two. So let's bring this all the way home now, because I don't want to leave you holding a pile of scattered facts with no real way to actually use any of it. Multiple major banks have turned bullish on gold within the same short window recently, and that kind of clustering almost never happens purely by coincidence in an industry this competitive. A 40-year relationship between gold and interest rates just broke wide open, and rules that hold for that long don't quietly fix themselves and go back to normal on their own overnight. There's a real, roughly quantifiable pile of hidden leverage sitting underneath the current AI infrastructure boom. And credit markets are already whispering warnings about it in the background if you know where to look. Central banks are buying gold at a genuinely record pace because they're hedging against a world with less blind trust in the dollar, not more of it going forward. Asia is importing at levels that point to something bigger than jewelry counters. And layered on top of all of that, there's a technical setup that, at least from where I'm sitting and what I'm watching today on my own screens, looks a lot more like a base being built patiently than a top quietly rolling over. None of that guarantees gold marches straight up from here in one clean, predictable line. It never has, not once in 100 years of market history. Even the most bullish research desks out there will openly tell you a sharp, painful pullback is still possible, maybe even likely, somewhere along the way before this fully plays out. That's not a contradiction in the story I'm telling you. That's simply what real structural bull markets actually feel like while you're living through them in real time, as opposed to how clean and obvious they look on a chart 5 years later once everyone's writing books about it after the fact. So here's my actual challenge to you, and it isn't complicated at all when you break it down. There are two people watching this video right now, and you genuinely get to decide which one you're going to be by the time it ends. The first person watches this, feels a brief spike of interest for about 10 minutes, and then does absolutely nothing with any of it afterward. They close the app, scroll onto something easier and lighter. And 6 months from now, they'll see gold sitting at a fresh new high and think to themselves, huh, I remember watching a video about that once. The second person actually does something with what they just heard today, not blindly buying anything. I already told you flat out not to do that. But going and looking at their own portfolio tonight, honestly, for the first time in a while, without flinching away from it, asking themselves whether they genuinely understand why they own what they own, or whether they're just holding it because everybody else around them seems to be holding it too. Taking the time to actually learn how to read one chart pattern properly, instead of bouncing between 40 different loud opinions online that all contradict each other by lunchtime anyway. That second person isn't smarter than you sitting there. Right now, they're not luckier than you either. They simply decided that understanding how the game actually works beats sitting around waiting for a certainty that never ever arrives on its own. I've made a genuine amount of money across my career, and I've lost plenty of it too, more than once, more than I'd probably like to admit out loud. And if there's one real lesson 30 years in and around markets has actually taught me, it's this: the people who win long term aren't the ones who correctly called every single top and every single bottom along the way. They're the ones who understood the underlying structure well enough to stay calm and keep their head on straight while everyone around them was panicking loudly. That honestly is the entire game, start to finish. So don't be the person who watches this once and forgets about it by tomorrow morning over coffee. Be the person who actually goes back and studies it properly. Re-watch the part about the pattern again if you need to. Write down the 4 or 5 real things I just laid out for you today, and then decide for yourself, with your eyes fully open this time around, what you're actually going to do about it. And I'll see you in the next one.